Hello, my name is Christian Rohrbach, and this is my Finance 551 Investment Analysis Industry Comparison. This is between the retail and transportation and logistics industries. The goal of this project was to compare two industries, five companies within each industry, picking one favorite company within each industry, and then comparing both industries at the end. So, for retail, my choices were Abercrombie and Fitch, Aeropostale Inc., American Eagle Outfitters, The Gap Inc., and The Buckle Inc. For transportation and logistics, my picks were United Parcel Service, Federal Express, Union Pacific Corp., CSX Corp., and Norfolk Southern. I want to note for the transportation and logistics industry, United Parcel Service and Federal Express are both companies that gross their revenues using truck, ground, and air transport. They also gross their revenues from logistics and logistical applications. All five companies in transportation and logistics gross 100% of the revenues within the industry. I just wanted to note Union Pacific Corp., CSX Corp., and Norfolk Southern are railroad companies, so they do differ a little bit from UPS and FedEx. So my methodology, I analyzed liquidity, I did a DuPont analysis, market value ratios, supply chain analysis, economic value added, and any company news if relevant. And I'm going to go ahead and get right into it. So for liquidity, current ratio is the ability to turn assets into cash within a year. And current ratio for Abercrombie and Fitch, as you can see, it's high. You want to see it above 1. You don't want to see it too high. So Abercrombie and Fitch is good there. Also, cash ratio, they're above 1. For cash ratio deals with solvency. It's an ability to respond to your environment. So Abercrombie and Fitch, they're good on their cash and current ratios. That's what we want to see. Straight into DuPont analysis. I'm going to focus on operating margin, asset turnover, financial leverage, and return on equity. Operating margin represents percentage of total revenues made up by operating income. For Abercrombie and Fitch, we see a 4 that declines to 2 over a 5-year period. That's disturbing. That tells me their operational efficiency is declining. That's not good. Could be due to increased operating income or decreased revenues. We're not sure. I would think because it is a retail industry, it's due to consumers not buying as much and they're not selling enough to consumers. On to asset turnover, they're relatively good, increasing from 1 to 1.4. Financial leverage, that stays about the same. And ROE is quite low, 1.38. Increases and decreases dramatically in 2014. Not the best. EBIT over expense at the bottom. Inconclusive data on Bloomberg. However, I would note for all the retail companies, they were able to pay their interest expenses. Market value ratios, price to book, and price earnings ratio. Price to book ratio is ratio of a company's shares over its book value of equity, and it's great to compare with other companies. And price earnings ratio is ratio of a company's share price to its per share earnings. And we'll go ahead and compare these to other companies as we go. Supply analysis for Abercrombie and Fitch doesn't reveal much. The consumer goes over there. We consume. Nothing to note here. Economic value added for Abercrombie and Fitch. It's in the negatives. We want to focus on not so much the positive and negatives of EVA, but we want to focus on the changes in between. As we see here, the company's not doing well. EVA is dropped and they're struggling. You also see WACC, return on invested capital. And I would note economic value added is an estimate of a firm's economic profit being the value created in excess of the required return on the company's investors. So it is very important. So on to the next company, which is Aeropostale Inc. Liquidity ratios, current ratio is fine. Current ratio decreases slightly over time. Could signify some trouble. As we're going to see, there is trouble with Aeropostale. Cash ratio, that declines to 0.44, means they're having trouble meeting their short-term obligations to an investor, signals trouble, risk. It's not good. Get right on into it. DuPont analysis, operating margin, that's basically operational efficiency, 17.16 down to negative 8.86, having some serious trouble in the retail industry. Their asset turnover remains constant. Financial leverage doesn't move much. The return on equity started at 58 in 2010 and dropped to a negative 41 over time. So Aeropostale Inc. is having some tremendous troubles right now, and that's reflected in this return on equity breakdown, which is a DuPont analysis. Market value ratios, price to book ratio, price earnings ratio, as we can see, 4.74 to 1.97. That is a decrease. The price earnings ratio inconclusive at the end. What to conclude from price to book ratio that declines? Could mean the company is earning very poor returns on a return on its assets, and that's basically exactly what's happening with Aeropostale Inc. Supply chain analysis, there's not much to see here. Great, so you see market share, very small for Aeropostale Inc. You can see EVA, ROIC, WACC, significant drops. It's got a negative EVA spread, terrible EVA spread. Economic value added's in the negatives. Aeropostale Inc. is having some serious troubles. Company news, former CEO Julian Geiger is trying to join Aeropostale, or she's being recruited again by Aeropostale to hopefully turn the company around to some more prosperous years. Unfortunately, she's currently CEO of a company that is also having some significant issues. Could be CEO related. Aeropostale Inc. is not my pick as an investment company. Next company, American Eagle Outfitters. Current ratio is high, 2.8 to 2.22. That's great. Current ratio, again, ability to turn assets into cash within a year. Cash ratio staying high, staying liquid in the environment, capitalize on your environment. They're obviously solvent. They can take care of short-term obligations. However, we're seeing a drop-off over time. American Eagle, as it turns out, is also having some issues within the industry. Get right into it here. Operating margin's pretty good for American Eagle. High at 10. High at 10 for 2 years. Drops down to 7.31. Back up to 11.5 and down to 4.27. That is a bit troubling. We want to see ideally constant operating margins. We do not want to see great fluctuations. That means trouble. Asset turnover. They're turning over their assets. That's good, and they're increasing over time. That's one thing they can do. It means they're pushing sales. Financial leverage, relatively constant. Return on equity, they started at 11.27 and dropped down to 6.99 compared to Aeropostale Inc. and Abercrombie and Fitch. American Eagle Outfitters is doing quite well. Price to book ratio, 2.08 to 2.24. Price earning ratio stays relatively constant like price to book. And as we'll see, American Eagle Outfitters EVA dropped over time. Not much to see here. Again, no significant information revealed by the supply chain analysis. EVA, it is in the positives. We're seeing some fluctuations here. Not a large market cap. I will say, analyzing industry, retail companies are having difficulties. Those that can't keep up with trends and fashions are left behind, sales drop, and trouble ensues. That's why I would say retail is a difficult industry to be in, especially when it comes to clothing, trendy clothing. All these retail companies are teen youth population and young adults. That's what they target, and that could be troublesome. So the Gap Inc. here, we have a current ratio 2.19 to 1.81. That is relatively constant, dropping over time. Cash ratio also dropping. That may be a problem. We will see here. All right, operating margin 12 to 13 stays relatively constant. That's great. Asset turnover remains at 2. Leverage does increase 1.68 to 2.57. That is significant. Return on equity 23.85 to 42.99. That return on equity is due to leverage. We want to see operating margin and asset turnover responsible for increases in return on equity. And price to book ratio for the gap stayed relatively constant. Price earnings ratio, well, actually, price to book ratio, price earnings both increased, which is good. EVA, as you'll see, is impressive. We do have supply analysis here, and the end consumer note. The end consumer is us. We consume. That's why there's nobody on the other side. High economic value added. You can see growing over time. That's great. Market cap for the Gap Inc. in millions, 11,000. EVA spread 16. ROIC 24.33. Significant. Company news: Gap Inc.'s closing stores. Loss in sales annually. They're trying to boost profitability. They're going to take hits up front and recoup those losses over time. This could be a buy low, sell high strategy if you don't mind waiting. Next, Buckle Inc. This is my industry pick. Current ratios remain high. Cash ratio remains relatively the same. This is what I like about the Buckle Inc. We're seeing steadily increasing operating margins. Asset turnover increases steadily. That's great. They're pushing sales. Financial leverage remains relatively the same, increasing slowly, which is great. We don't want to use too much leverage because it magnifies gains and losses. Return on equity shoots up to 49.77. The Buckle Inc. is doing great. I love everything I'm seeing on this ROE breakdown. Makes me feel confident. Price to book ratio is rising. Price to earnings ratio is also rising. That's great. They are using their assets to generate revenues, and their book ratio and earnings ratio reflects that. Not much to see with the supply chain analysis there, but this is a great EVA graph. Steady climb. This is a growth stock. It's what I call a growth stock. Market cap isn't large. EVA spread is tremendous in the positive for economic value added. The Buckle Inc. is doing excellent. They seem right now to be resilient to any sort of industry downsides. So like I said, Buckle Inc.'s my pick for retail industry. Impressive operating margins, financial leverage great, continuous growth, financial analysis indicates excellent leadership and management. That's why I go with the Buckle Inc. My second would be the Gap Inc. Straight on to transportation and logistics, UPS. Let's look at the current ratio. That drops over 5 years. It's above 1, which is great. Not too alarming. Cash ratio is low. Look at it from 0.69 to 0.38. UPS is front runner in transportation and logistics. I don't think anyone's going to doubt them, but they can't be liquid in their environment. They can't capitalize on opportunities. They can't move fast if their cash ratios are low. As we'll see, UPS is having a bit of trouble. Operating margin for UPS, great until 2012, dropped significantly, increased then decreased again. Asset turnover remains about the same. Financial leverage for UPS, note how it doubles over 5 years. 4 is already high for financial leverage. That increases to 4.55 and all the way up to 8.32. ROE is very high for UPS. ROE is basically the amount of net income returned as a percentage of shareholder equity. And investors like to see higher ROEs, but if it's grossly exaggerated by financial leverage, that doesn't do anyone any good. EBIT expense, as you see at the bottom here, we do have data for that. They can cover their interest expense over 16 times, so not having any problems there. Price to book ratio for UPS increasing. Price to earnings ratio also increasing. Supply chain analysis, there is something to note here. We're seeing 6% or more for 2 companies. Actually, if you add these up, you got 13% or more for UPS. That's not extremely significant, but if any one of them were to drop out, especially Navistar International, that would be a big hit. All right, you're looking at EVA for UPS. It's in the positives. Spread is 2.89 minimal. Market cap's massive for UPS. And as you can also see, WACC 7.6. Economic value added, return on invested capital. And we have our graph here. Something took place at this point in time. I don't know. 2012, something very significant. That's not even 2012. On the previous slide, 2012, something very significant happened, and I wasn't able to figure out exactly why. I'm not sure. That may be incorrect information in Bloomberg. On to next company, Federal Express, increasing cash ratios, increasing current ratio, great. Cash ratio is 0.5. It's not dropping dramatically. It is increasing, which is great. We want to get that up to 1. Not too high, not too low. Operating margin for Federal Express from 5, it moves on up to 8. That is great. Asset turnover remains constant. Financial leverage doesn't go any higher than 2, unlike UPS, which is its closest comparison. Return on equity shoots from 8.59 in 2010 to 14.24 in 2014. Note, with UPS, I actually did plug in the financial leverage of UPS into one of FedEx years, and they come out to be about the same. So Federal Express is as efficient, except they're taking on less risk. Increasing price to book ratio and price to earnings ratio drops just a little bit. Federal Express note here, we have the Boeing, 12% of their business. That is quite a concern. 12% of your business with one supplier, coming from one supplier, that's significant. EVA for FedEx, we're seeing a little bit of a battle here, but that's not bad. They are in the positive for economic value added. Market cap's 42,000. ROIC is 8.29. News for Federal Express, and this is big news. I recently purchased Dutch freight forwarding company TNT Express for $4.8 billion. UPS tried to do this. They're going to expand further overseas in their market. They're going to expand their presence. Federal Express is going to expand its presence further into European markets. That's great for Federal Express. They're lagging behind UPS, and that could be the key to growth. So this begins the railroad companies. Like I said, all 5 gross all of their revenues from transportation and logistics. United Pacific Corp, CSX Corp, and Norfolk Southern all gross their revenues from railroads. So their analysis looks a little bit different, and we'll see that now. Current ratio sticks around 1. Cash ratio low. You would think not volatile in the railroad industry. Think differently. I will say this only goes up to 2014. My analysis indicates that the railroad companies are having significant troubles right now because of decreased costs of coal and resources and increased transportation of resources like oil through pipeline transportation. That's hurting the railroad industry. Other than that, they look pretty impressive. Very high increasing operating margin. Asset turnover remains at 0.4. Financial leverage around 2.5. Return on equity increases over time. They can pay their interest expense easily. Union Pacific Corp doing great. Increases across the board. That's what we want to see. Price book ratio increasing. Price earnings ratio also increasing. That's great. Supply chain analysis between 2 companies. That's 7% being supplied by 2 companies. That's not too much. GE and Coopers Holdings. Market cap 78,000. Absolutely massive. They're in the positives for EVA. They have a good EVA spread. Union Pacific Corp, as of 2014, is doing great. As I indicated, recent news has suggested issues with railroad companies. Liquidity for CSX Corp, current ratio 1.13 to 1.22 at the end there. Cash ratio a little bit better than Union Pacific Corp, about 0.5. We would like to see that at 1. Operating margin not increasing as steadily as Union Pacific Corp, but very steady. You would think with railroad companies transporting goods to and from, they would have to have their operating income and their operations down to a science, and that's what we're seeing here. Extremely high operating margins. That's how they survive. Asset turnover is minimal. Financial leverage 3. That's a little bit more than the other two, Union Pacific Corp and Norfolk Southern. Return on equity steady around 18, decreasing in 2014. I believe you see 2015 actually keeps decreasing. Price book ratio 2.75 to 3.26. Price earnings increases. That's great. Some big suppliers here, 12% for 2 Freight Car and Coopers. That should be noted. EVA spread jumping up and down here. You also have WACC and ROIC. It's in the positives for EVA. And return on invested capital, 11%. EVA spread is 2.8. This brings me to my next company, which is Norfolk Southern. It's a third of 3 railroad companies. So we have current ratio sticking around 1. It's actually increasing, and its cash ratio drops but then increases. Operating margin is very high. That's what you see with these railroad companies. Very high operating margins. That's how they survive and thrive. Financial leverage, 2.6, relatively stable. We don't want to see an abuse of that leverage. That's what you saw with UPS. Return on equity increasing, and it can pay its interest expense pretty well. So the 3 railroad companies on book as of 2014 are doing good. Price to book and price to earnings, that's shooting to 17 for price earnings ratio, and price to book is 2.1 to 2.72 over time. That's good. Supply chain analysis doesn't reveal anything too significant. So economic value added, we're seeing in the positives for EVA, Norfolk Southern. Return on invested capital is 10%. EVA spread's good. Again, seems to be a little volatile, or it seems at least to be going up and down quite a bit. As I mentioned, Union Pacific Corp, CSX Corp, and Norfolk Southern Company news. Decreasing cost of coal threatens railroading companies relying upon resource. Oil and natural gas continue to be transported via pipelines at a growing rate. It's causing quite the trouble. And so for transportation and logistics industry, my favorite is Federal Express. And my reasons, it achieves similar return on equity when compared to UPS, which uses too much financial leverage. Its recent acquisition of TNT Express offers possibilities for increased growth in European markets, and avoiding railroad companies due to trends indicating near future struggles. This could be a buy-in lower, and over time, if you just wait out a little bit, FedEx may overtake UPS. I think there's some tremendous growth potential there. So as we get down to it, the BuckleLink versus Federal Express, my favorite industry and company, transportation and logistics would be Federal Express. My reasoning is that transportation and logistics is a necessity, and if I have to invest, I would rather invest in necessities. What I noticed with retail companies is they are trendy and they're seasonal, and only the best survive. And even though the BuckleLink's doing great, that could change very quickly. It could go from a growth stock to a company like Aeropostale. That dropped dramatically in performance. So Federal Express is my choice. That's what I pick between the 2 industries. I do like transportation and logistics over retail. Again, the BuckleLink, excellent return on equity, financial leverage kept low, high operating margin, steady growth, high EVA spread, everything done right by the organization. But it's not without risk. As I mentioned, Abercrombie & Fitch, Aeropostale Inc., American Eagle Outfitters, they're all currently struggling due to changing trends. And that could be the BuckleLink. So I've learned a lot preparing for this presentation. It certainly has opened my eyes quite a bit. And if I do invest, like I said, I would have to invest in transportation and logistics between the 2 of these. I hope this was informational. Thank you.